Good morning. Hey, this is Ken Himmler, and I'm returning back on YouTube again. And I know it's been a little while, but I don't like jumping on YouTube unless I think that there's something that's really important to talk about or to discuss. And I want to talk about, without the fancy underlying music or special effects or video enhancements or anything else. This is just me talking to you about what's going on in the economy and what you need to be aware of. And as you know, yesterday, Donald Trump signed into law the ability for 401ks to accept additional alternative investments. This would include gold, silver, crypto, alternative funds such as hedge funds, private equity, etc. So I've been getting a lot of emails coming in asking, what does this really mean? So let me give you my take on this. There's two parts to this. One is macro, one is micro. The macroeconomics are that if you think about the stock market and why it's continued to increase, it's a supply and demand. And yes, while there are new companies coming out, there's also companies closing and consolidating. However, when you have an increasing population, as Warren Buffett said, if you want to know about how to gauge what the stock market's going to do, just look at the growth rates, the birth rates, versus the death rates. And we know that our country is continuing to grow in population. As the population grows, more people go to work. Now that under Secure Act 2.0, it's a law that most companies have to include a 401k as a mandatory benefit, meaning they have to set it up and they have to include new employees. Now, employees can opt out, but most don't. And so this means that they're entitled to the company share as well as the employee share. This means that you have a forced buy-in. Now, if you go prior to 1977, when there were no 401ks, the stock market was based upon supply and demand. So if the retail investor was feeling good, the institutional investor was feeling good, they would buy into the market. The more they'd buy into the market, the prices would go up. However, today you have a different dynamic. The dynamic is, and this is just an opinion, this is not a guarantee that this is going to happen, so I got to throw that little disclosure in there. But if you have an increasing population, an increasing wage base that's going into 401ks, and the only two investments that you could buy in a 401k was a stock or a bond. Now, I don't care how the methodology that you use, whether you buy it through an ETF, whether you buy it through a mutual fund, or even whether you buy it through setting up a self-directed account. You still are buying stocks and bonds because those were the only two permissible investments. So what happens is when you get these funds that are going in, it's automatically buying into the stock market, thus creating an artificial supply and demand. People are buying into the stock market, pumping up the prices over a period of time. That's a good thing if you're investing in the stock market. So that's from a macro perspective. Now let's take a look at the macro perspective of what does it mean when now we have crypto, we have hedge funds, we have all kinds. I don't even know if they're going to allow SPACs in there, but we'll see. But now what happens is you have a dissolution, a dissolving of the, am I using the right word here? Dissolution, of the forced supply and demand in stock and bond markets. This means that certain people are going to choose alternative investments, even in some of the funds that might be, say, target funds. If a target fund now realigns with a diversified portfolio of all these other types of investments, now what happens, you don't have as much money going into the stock market. Now, good and bad. This will affect everybody that's in a 401k, and it will affect everybody that is in individual investments, meaning that it could be in your trust account, it could be in your Roth account, it could be in your personal IRA. This is a long-term macro effect. It's not something that we as a firm are concerned with right now at this given minute. However, we are dutifully, is that the right word in the morning, but we are making sure that we are keeping our heads in the books on what's going on with this 401k and how it may affect some of the macros in the market. Now, that's macro again, that's longer term. Now let's talk about shorter term and how that might affect you. So the problem with adding these additional investments, in at least my history and my experience, is I do not like most private equity funds. I do not like most privately listed REITs, real estate investment trusts. Here's been my experience of these things. Whenever these private funds come out, they're not required to report in the same way that a public stock fund would be required to report. So 10Ks and transparent P&Ls, transparent balance sheets, transparent dissolving of shares or repurchasing of shares. All of those things are hidden inside private equity. They're hidden inside of hedge funds. You can't really find out what is going on underneath the layers. So from a micro standpoint, I am very worried, very, very concerned that people are just going to see something on their 401k statement or on their choices and says hedge fund, and they go, ooh, that sounds really sexy. Let me buy a hedge fund. Or crypto, let me buy crypto. And it's going to result in a lot of investor losses. And I also think it's going to massively increase the amount of fraud that's going on. Now, fraud can be either illegal or, in my opinion, there can be what's called legal fraud, meaning let's say that you have a private equity fund. And we've seen this happen a million times where the private equity fund, and I see this a lot with privately listed REITs. These things are the love child of brokerage firms because when they sell these things, they're making 7, 8, 9% commission. And so they're hyped up. They tell you all the great benefits of the private REITs. And here's what I have found, and my problem with private REITs, is you can usually get a publicly listed REIT with complete transparency of the properties they own, what are the salaries of the executives, what are the expenses, what are the profits, etc. The minute you go and these privately listed REIT companies create these side funds called private REITs, and they limit your distributions, they can shut off your distributions, they do not have to report everything to you. So if and this is what I found, they get in, they say, hey, we're going to promise a 6% rate of return. The average investor goes, oh, okay, that sounds good. People then put the money in, they raise 10 million, 20 million, 100 million, $1 billion, whatever it is. As soon as they raise that money, all of a sudden, now their salaries increase of the executives. All of a sudden, now they buy a private jet. And then as times get hard, as we've seen a number of different times over my 42 years, the minute that the real estate market gets a little soft, then they cut off or cut down the dividends, or they stop them altogether, or they stop redemptions. So these are all controllable factors by whoever issues these funds. Now these funds are going to be allowed to be purchased inside a 401k. So from a micro level, I think more than any time in history, and whether it's us or somebody else that's really worth their salt in as a complete independent fiduciary that does not work for a company, does not earn commissions on the sale of investment products, but somebody that can peel the layers back of all of these different investments and make sure that you're not putting what you are planning on for your future into these things. The other complexity that I can now also see is that when we model out somebody's retirement and we model out growth and then switching over into the distribution phase, we are, from our standpoint, looking at 100-year statistical volatility, 100 years of statistical data to create the best model that we can to model out cash flows, taxes, etc. The problem with everything like crypto, hedge funds, private equity, there's no way to model that out because first, there is no long-term statistical data on that. And number two is there's absolutely no way to get full disclosure or transparency on those kinds of funds. So going forward, all I can tell you is you better make sure that you have a really good fiduciary that is not working for some brokerage company or some financial firm that has connections with financial companies, that they would be incentivized or give bias to the purchasing of these kinds of investments without thoroughly ripping them apart and really understanding what's underneath the hood. So I'm going to conclude today. I didn't want to make this a long one, but I did want to put this out there to make sure that everybody really has their eyes open, because this will change, again, macro from the long-term stock market, I believe, and on a short term, which you have to be really, really careful of with investments. Ken Himmler signing off.